Biggest one. I mean, I'm in a few deals with that I thought was just a phenomenal operator. I mean, we have 30 units we're going to sell, and I'm talking to JLL, Marcus and Millchap, right?
Yep.
That wasn't. You kind of want a mixture of both. So the 10 years nice because it's stable, but the guy that's fixed for 10 years, unless someone's just giving you a phenomenal purchase.
Today, I have Brian Ferguson with Furgmar Capital, and I'm super excited to have Brian today because he has a history of experience that not a lot of our other investors or guests have had so far. He's actually been doing deals through 2 market cycles now. He started investing in single family, leading into the 08-09 crash, transitioned into like duplexes, triplexes, quadplexes. Then he went into neighborhood retail centers, and now they are back into apartments as well because he views this as a great time to buy. So if this is information that you're excited about and you've enjoyed the show, or if it's your first time, you haven't done it yet, hit that subscribe button and let's jump into the interview with Brian. Okay, Brian, thank you for being here. I'm excited to have you on the show. And I was thinking about this, which I maybe should have confirmed with you beforehand. I think we met at a passive investor event a couple years ago, and I'm trying to remember if you are like brother-in-laws to somebody I know.
I don't think
was it passive investor event that we met at like 3 years ago?
The first time I met you was at the PI event. That was last year in Dallas.
Okay.
And I've seen you at a few. Actually sat behind you at the Limitless one, but I was there for like half a day. So
I was too. I went home sick. I had I was like, I can't stay here. Like I'm actively avoiding people. I'm sitting in the back. I think I had possibly the latest round of COVID. I had low grade fever for almost a week. So, what about, Tyler at Unbridled? Tyler McGee? Do you know him?
Yes, I do. Yep.
Okay. I think that might've been the connection, and maybe I thought y'all had a family connection.
No,
for some reason.
No, I just know him from the same conference. And then I don't know, were you at, maybe it was Pi, and then were you at Best Ever this year?
Yeah.
Okay. So I probably saw you there. I've seen you at a few different ones in passing.
You start meeting people and you forget, but okay, sorry. We'll jump out of that. But Brian, why don't you introduce yourself, and Furgmar Capital, and then let's just get the conversation started with like, what's your background? How did you get to where you are today?
Okay. Condensed version there. So Brian Ferguson, I'm the managing partner of Furgmar Capital. That's our capital side of our parent company, Furgmar. We have a few different divisions. Started out right at 20 years ago now. I was in the finance industry as my background. I did finance in the automotive industry, and I was running some finance departments there. Man. Started doing some, that's when the Flip This House was huge on TV, kind of becoming a household thing. And so I started flipping a few houses. That turned into a kind of a full-time gig. This is in 05 going into 06, 07, 08. So walked out of my full-time job to go flip houses, and what ended up being probably not the best time. Thankfully, I was not married, did not have kids. I could run, and I was making good money. So I had a nice savings account. So I could run very lean. And I did that for, no paycheck for probably 3 or 4 years. What it did is we ended up having to hold on to quite a few properties and rent them out because they just weren't selling. So we made the decision that you fast forward, that ended up compiling about 150 house portfolio over the years. And then now fast forward a little bit and the market recovers, 2010, 2012, we start selling these off a couple at a time, buying multifamily. We did that. Then you fast forward, we start selling off some of the multifamily that we had 1031 did, and we're buying bigger multifamily. And that just kind of went on. The whole while, we still have this single family division doing 100 to 200 transactions a year. That was our original thing. It just continued going. And then about 19, got to the point where we had 1031 most of it. We'd bought some bigger complexes, and we got to where, we're selling something off and you got, a couple $100,000, and what do you do with it? And so I started going into COVID, I started passive investing. And so through the COVID kind of lockdown, I was passive investing and sitting at home and thought, this is fantastic. The second we all came back to work, I realized was not for me. I was 34, 35, whatever it was at the time. And so started partnering. We started buying some shopping centers, me and a few guys, and then that just fully turned into kind of syndicating some deals. So now we're actively buying shopping centers and multifamily, and we still have our single family division. So that's our 20-year kind of in a nutshell.
Okay. So are y'all still acquiring single families, what you said?
Yeah, just for, we have a fix and flip division, fix, flip, wholesale, a little bit of every hotel, but not for long-term holdings. Then on the long-term holding side, it's just kind of 100 to 300 apartment unit complexes and professional sized neighborhood retail centers.
Okay. All right. Well, that's good to know. And I want to spend most of our time talking about the retail centers and the apartment complexes. But for a lot of our investors, they're newbies. They're fairly new to the commercial side. So most of them are primarily thinking about single family, or maybe that's what they've historically thought about. So why don't you talk about single family rentals in today's market? And so what market are you in? And then how has that changed from 10 years ago?
So we're in, our corporate office is in Victoria, Texas. So we're kind of 2 hours south of, we're 2 hours from Houston, Austin, San Antonio, 2 hours from all those, kind of triangulate your way. And from single family, that's where we are. We have a large portfolio here, and then we're in about a 2 to 3 hour radius on long-term holdings. We don't actively, the past, because, I just talked about 05, 06, 07, 08, we just went through a baby version of that. And, we were prepared.
We might not be totally through that yet.
Yeah, we're
close to the bottom, hopefully.
Yeah. I think we hit our bottom and got rid of all of our old inventory. That what happened in 06, 07, 08, it took us longer to realize it because we were newbies. I was 18, 19. And so by the time we decided to hold, it was quite the package. We saw the time coming, and we have systemized processes. So we didn't have to hold as many, but I think we probably put 5 into, it was like, hey, lose 50 grand or rent it out for 5 years. So I think we had to put 5 or so in there. I actually deal with quite a bit. One of our kind of big on the single family side is we deal with these investors, and we have a program where we'll sell to them. We finance it for them while they get through the rehab, and then we help them get these 30-year DSCR loans to turn it into a rental property. Yep. So we're in a smaller market. So most people here are like, I got to go to the bank, get a 15-year note, put 20% down. If it doesn't cash flow, it doesn't work. Well, in today's market, 10, 15 years ago, you could actually make that work. You could put 20% down in a 15-year, and now they just don't pencil at all if you're not Correct. Doing it in the masses. So,
and in the larger markets, 20% down on a 30-year doesn't work. I'm in DFW, right? Like it's not going to cash flow there at all. Clients that, you got to put maybe closer to 50% down, and then your ROI is terrible.
Wow. Yeah. I think the only way they're making these work is because they're buying it at like a wholesale fix and flip. Yep. Like they're buying it like it's a wholesale for a fix and flip, yep. doing the work, and then, and a lot of times we've been successful, and they've been able to get 100% back. So they're out of pocket next to nothing. If I put that into my underwriting model and hit it for, standard vacancies and concessions and loss to market, if we did that, like we're underwriting a multifamily, these deals wouldn't underwrite at all. I mean, they're looking at like, my payment's $23.50. I can get $25.95. I'm making $200 a month. This works.
Yeah.
For them, like I got a guy in 2 years, he's built up 12 of them, and he's 30 years old. So when he's 60, 70 years old, if he has 20 of these things paid off that have appreciated to 200-300 grand, that's still, that's his purpose on it. So
single family, and this is one of the things that, I've learned through working with Keith, is like single family is probably the most reliable way to achieve long-term wealth and independence. It's not going to be the fastest, but if you do it and you just do it steady and you work the plan and you keep at it, it's a very reliable way to get there on your own. Now, are there faster, also reliable ways? That's why we have the podcast. All right. So, why, tell me about the transition. So why did you want to move away from, you're doing single family on a pretty large scale. What was the reason for the transition?
So transition from single to multi to shopping centers back to multi is all kind of tied to the same reasoning. You got to follow the market. Like, I'm not saying you can't be in a space and be in it forever, but the single family, when we're buying these, I mean, you're buying $10,000, $20,000, $30,000, tax sales, foreclosures, and you're able to rent for $859.50 a month. Well, once those houses became worth $150,000 in 2010, 2012, now I go buy it and I'm struggling to make it cash flow. So it just didn't make sense. And at the time, 2010, 2012, you could get a pretty good deal on multi. And then eventually that wasn't the case. So, but yeah, it was never really our intention to be in the space. We just ended up having to put 20 or so in it. And then we just we just ran with it. And we just kind of had this, we'll sell it or rent it mentality. And, when you're buying 20, 30 houses a month in a busy month, a few made more sense and it rented faster. So it's great. I think, when you hear to your point earlier, you can build it. And I think when you have 20, 30 of them nowadays, like, let's not focus like build to rent communities, because I didn't have 150 in a community. That would have been a different story, right? That's not comparable. That's like a version of multi, but these are all over the place. And it was just so hard to really look at the portfolio, and insurance is a nightmare. And there was no economy of scale at all whatsoever. And we just thought the next step was fourplexes and duplexes. And that was no better. I mean, I honestly would rather have the single family. I still have about 300 units worth of duplex and fourplex, and it's like the epitome of my gray hair, my beard. But I would take the single family over that from a standpoint, but again, they're good if you have, I think, 10, 20, 30, something manageable. At a certain point, it's just not manageable. Yeah.
It really becomes a business. And so are you going to actually run it like a business? But even then, you're still running into the issues you just mentioned.
Yes,
right?
Absolutely.
Economies of scale, all that stuff. So, okay. So, tell me a little bit about that early transition into multifamily. When was that? What did that look like? Was it just opportunistic, or was it, something a little more intentional?
It was more opportunistic. We just became known for if you want to sell, like we went from we buy houses, just very old school. And then we buy and sell houses. And then we went into we buy and sell real estate. We ripped all the logos off the trucks. We had all the technicians had them, and went to we buy and sell real estate, because we would buy land, do like a large, tract development, buy a couple hundred acres, couple thousand acres, whatever. And I was we used to sponsor the realtor events a lot, still do. But, I was there, and an agent said, "Hey, I have this 16 unit apartment complex." I think we already had a few duplexes that someone had called us and to us it like bolted into the rental, but we didn't have anything bigger than I think 2 or 4 units that I can remember. But this was 2009. We had just bought a mobile home park at foreclosure. So we were kind of getting outside of our realm a little bit. Back up. We had the mobile home park. This is a year later. We were selling the mobile home park, and we needed somewhere to park those funds. And he said, "We got this apartment complex. These doctors own it. There's like 14 of the 16 are vacant. There was a fire on one corner."
Oh my gosh.
And I won't even get to the price he said, but it was like nothing, And we thought, man, this is so cheap. And napkin, pencil, they're going to rent for $450 a piece times 16, and my payment will be this. Well, then we got in there and learned what it took to remodel a bunch of multifamily. And so it started there. And then you still had some, this was 2009. So we're just coming back from like the recovering market. And then we bought another 21 unit off of foreclosure. We liked that. So then we took down some 30 and 40 units, and then that's when we really started aggressively selling everything off. But we had so many single family that I could go list, these things even with a refi, you may owe $20,000, $30,000 and they have a market value of $150 minus closing costs and all that. So if I could slap 10 on the market, do the math, I have enough to buy something sizable. I can go buy a 30 unit and that's what we were doing, and just constantly kind of just moving that money around. And then we had enough to where we could get into the 100 units. And, but then it ran out. There was nothing left to 1031 unless we wanted to sell. We got to a point where we were left with a bunch of stuff we didn't want to sell. And then we had a couple hundred left, which we still do, a duplex, fourplex, and they were either newer in the inventory, whatever reason, it wasn't the right time to sell. That process kind of stopped.
Okay, now I'm gonna jump forward right now, and we might jump back. But you were buying you were selling single family, you were buying multifamily at a time where multifamily wasn't huge, right? It wasn't the most popular thing that everyone was doing like it was in 21. And there was a market shift in that range. Actually, remind me, what was the year that you approximately started doing some of that? Was that in the early teens?
We bought the first multi, you're saying?
Yeah.
That was 2009, right?
Okay, so that was 9. Okay.
Yeah.
Okay. So what are you seeing like in today's market, right? That multifamily's taking a big hit. We've had someone else on the show that we've talked about that to some degree, right? So where do you see the opportunity right now in today's multifamily market? And I'm sure we'll hop back and forth a little bit, but
Sure.
since we're talking about that transition, I think that'd be good to know, because you've been through one transition, which was a little more single family centric, and this one's been pretty hard multifamily. So
yeah, I mean, I will say, like, kind of referencing though on that 9, one of the big differences you see is, like, I get flyers sent to me all the time of 30 units for sale. I mean, we have 30 units we're going to sell, and I'm talking to JLL, Marcus and Millchap, right?
Yep.
That wasn't 2009. Marcus and Millchap wasn't brokering 30 units in Victoria, Texas. It just wasn't a thing. A local broker got it. No one wanted to buy it, and it would just sit on the market and you'd get it for pennies on the dollar. So that has really shifted. What I see in the market now, we phased out. We bought a complex here or there, but we virtually phased out, and we really focused on kind of retail professional centers because the market just went haywire. I mean, nothing underwrote the way we want it, but we heavily underwrite for cash flow, not for ups. I mean, upside's fine.
upside's great, but
upside's phenomenal, but we never took capital until 22. So before that, I didn't look at the upside sell. I looked at, what is this cash flowing for me in my that's what we always looked at. So when we started, it got to where nothing could really cash flow. And if you didn't have the upside, and then I would always look at, this is a 5-year rate at 3%. And what happens on year 6? And it would break the spreadsheet every time. And that's what's happening in real life right now.
Giant red question mark. You had no idea. Yeah.
And people.
Okay. So that was the transition.
Yep. And then, but like the way I see the market, I think we're now in that coming off of a bad market. And I think we have a 12 to 24 month window of getting some of the best deals that you'll see for 20 years, until the next cycle. That 08, 09, we're there now, and you're going to see that for a few years, and then it's going to start kind of leveling off. And I think there'll still be deals, but you're not going to find the distressed deals that you can see right now. I mean, I'm sure a lot of people are saying this, but the amount of deals that come across our desk, we're picking which one we want to put an LOI on. Whereas last year, it was just, there was nothing you could, hardly.
Okay. And I have been around some guys who are in your world, right? And they're sort of speculating, sort of feeling like this is that time to start getting back in. Right. So is that kind of I guess tentatively, that's where you're at. You're like, hey, we do need to start getting back into multifamily because the opportunities now, and now your criteria, how you structure deals are probably different.
Sure. Yeah, absolutely. I mean, even over the past, because like I said, we bought at least one complex per year, and they were good deals, but they weren't what we're seeing today. And because now, and we just looked at an underwriting sheet the other day, and the metrics that, the team's like, this is great. And I'm like, no, I don't know. And I mean, literally one of the guys at the table said, you would have jumped up out of your chair for those metrics last year. And I'm like, well, we got to change with the market, because now we're seeing, we're seeing stuff that, like we bought one earlier this year. It's 30% off of, market value, that people are losing money. I mean, I don't want anybody losing money, but they're going to be lost. And I mean, someone needs to take them over. So, but yeah, we're definitely underwriting differently and more aggressively, just because I think everyone has a capacity thing. And for us, like, I'm only going to buy so many at a time, and I don't want to get caught in one deal and then miss the next one. So I think you got to be real strategic on that. And I don't have the magic wand to figure out how to pick them either. So
yeah. All right. Well, tell me this, or at least what you're able to see on these deals that y'all are looking at and doing. I don't know how much insight you have to the other side of the deal, but are you frequently seeing these deals you're looking at being significant, equity wipeout for the sellers?
Yes. I mean, I can give you two kind of specifics. The one we just closed on, I mean, they probably had somewhere around, somewhere in the, give or take 8 million range in it. And, we ended up final, after it was all said and done, about 5.8. They owed 4.6. So, I mean, they still had, I think after closing costs and everything, I think they had just south of $1 million in equity. But so, I mean, there was probably a couple million equity loss there. And then we have one that we're just now contracting that, we're contracting 17 and they have 25 in it. And it's literally almost to the penny payoff broker's commissions and closing costs. We were going back and forth over $10,000 because they want it to be a break even. So it is 100% loss of, investor capital.
So even that first one was probably a 70-ish% loss of original capital. And that's something that I think that investors, I wouldn't even, I'd hesitate to say are learning. I'd just say have learned in the last year or two, right? Is a lot of the coaching programs talked about how real estate, like the value of the asset would never go to zero, right? And that was kind of what was pitched and what people would think about. And then what we're learning is it doesn't have to go to zero to wipe out everyone's equity.
Yeah.
Right. It only has to go to 80% sometimes, or maybe 75 or 70. Yeah. And if you aren't able to cash flow and carry that property, then you have to get rid of it, right? It's either foreclose and it's totally gone, or you sell it and see if you can recoup anything. So has the way y'all structured your own deals changed because of what's happened in multifamily the last few years?
Sort of. I've always been very against floating debt in any form. Just we were very old school in that aspect because we bought all of our stuff with 15-year fixed notes from a local bank. So, I've actually had to, as crazy as it sounds, get a little bit more comfortable with everything not being fixed forever because that just doesn't always work. But we're very hesitant on that. There have definitely been shifts, much more conservative. I'm not going to sit here and say our deals are perfect. We had one of a deal we bought 23, beginning of 23, and learned the hard lesson about if you're under contract for a very long time, redoing due diligence all over again, and they had to get the numbers. They'd put ghost unit. It's completely fraudulent seller, but it wasn't a big enough deal. It was one of like 19. He was already being sued, and our attorneys said, there's nothing left. So, we haven't given any distributions, and we just finally refinanced it. And now we'll start seeing some, but it hasn't been great for the investors. Fortunately, it was a small enough deal that we funded the additional, so we didn't do capital calls either. But I think, and that's why I say, I feel for the people over here on the $25 million deal that we're talking about, because that's what happened to them, was a fraudulent seller, and they didn't catch things, among some other things. But would I have been in their same shoes? Let's say I had to put $600K into the $3.5 million deal. We'll multiply that out. And I think that's what happened to them. I'm glad I learned on the 3.5, but that was also intentional on our part. Our part was start small and let's grow it up. So, but I'd say the biggest shift is just trying to be more really focusing and changing the exit. Even though we haven't always really banked on the upside, we really try not to bank on the upside now. We've gotten real aggressive on, not only does it cash flow, just we've upped those numbers. Used to, okay, does it have decent cash flow? Okay, can it cover a pref? Now it's, can we hit double digits at stabilization? And if we can't double digit cash flow at stabilization, 9 times out of 10, we're going to pass. Okay.
Yeah. Double digit cash flow is pretty solid.
Yeah.
It's not
easy to get to. You have to be really efficient in your operations, but our experience is that. So,
yeah. Okay. Well, what markets do you guys buy in and why?
So Victoria market, obviously. For multifamily, we're looking at a few. We recently underwrote a deal in Kingsville, some smaller markets. We are shifting that now because we wanted to be in the smaller market mentality. Still similar, we're not going to be buying in downtown Austin or Houston. In the professional retail centers, we entered the Katy and Sugar Land market earlier this year, buying another one there now. So we're actively looking pretty heavy around there at multifamily because it'd be great to be in the same market. But we kind of have an old school mentality of, and this will expand, I'm sure, over time. But right now, we very firmly believe that it doesn't matter how good your property management is if you don't have great asset management. And so I want my team to be able to get there fast if there's a problem. So we do kind of within a 2 to 3 hour radius of our home base is where we're at. So, but all Texas right now for us.
Okay, cool. That's good to know. And I know I've had clients who they want their money to stay in the state they live in, right? They want to, and the reality is it should never happen. But as a limited partner or a passive investor, they're like, I want to be able to drive there if I have to. It's I don't know why you'd ever have to, but that is kind of the thought. Is I want to make sure that I'm understand at least the general macro market of where my money's being deployed, and it's all going to vary significantly from suburb to Austin, Houston, Dallas, all that, but. At least the laws and the macroeconomics and political environment are relatively similar. Relatively. pull Austin out of that. Say relatively similar.
Yeah.
Okay. All right. A lot of our listeners will be somewhat familiar with multifamily. We haven't had anyone on yet who has talked about retail centers, right? We've had a guy who specifically, Zane was great. He specifically does single tenant triple net leases. Is that exactly what you do, or do you do larger retail strip centers? Because I really want to dive into what y'all do.
I do not do what Zane does at all. Complete opposite. Actually, that's a good
Then
point.
Great. That's what we want to hear.
Call Zane and let's exchange leads. But so he's pure single triple net. That's great for their funds. It's a good cash flowing piece, not our angle. The structure of these deals is going to be very similar to what you would see in multifamily. You're going to see high teen IRRs, 2x multiples, like very similar metrics you would see on a multifamily, similar concept. The centers we specifically go after, and the reason you'll hear me go neighborhood retail / professional is because there's not a standardized name for it. So if you think of brand new center next to the new HEB, and I'm going to find all the high fashion stores, nope, that's a true retail center. That's not us. So we're going to find something that is, I say professional. So one, it's going to be neighborhood style. So it needs to be surrounded by a lot of rooftops because that's the tenants you'll have in it. You're going to have a hair salon, a nail salon, and Edward Jones. Think of the places mom and dad stop going to and from the house.
The liquor store.
Yep. Maybe a dental office. We have like a behavior academy school in some of ours. We have a chiropractor, hot works. It's things that you need a bunch of rooftops to support. And then we go after our ideal center is going to be 2,000 to 2015, somewhere in that 10 to 20, 30-year-old range, somewhere in the 10 to maybe 50, 60,000 square foot. I mean, it's an interesting market because if you find these centers that have been owned, 5, 10, 15 years, and it's not this big syndicated, like blown up market. And these centers, so the big stuff by HEB is going to be owned by some massive conglomerate, right?
Yep.
Right in my league. But these centers are going to be owned by they may be an investment group. They may be a group that's in another space. They're big in medical or they're big in this and they just had the center, or like the big single tenant, like they develop, say Walmart's academies. This will be the shadow space that, the big single tenant, like, Zane came in and bought the big single tenant building or somebody in that group, but they don't want the shadow space. So then the shadow space is just left in this guy's portfolio, or like we're buying one right now. It's a group of brothers, they're attorneys and doctors, and they have
That's what I was going to say, a group of doctors that one guy got the hair, put it together, got his buddies to buy it. And they got a bunch of doctors running a retail center.
Like, I had my practice here. So I built the center to have my practice, or bought the center to put my practice. I've now retired, but we go after the ones that have been, they have a bunch of leases that are either expired, they've been expiring. They've already, like the one we have now, it's 30-something%. There's 2-year vacancies on there. But in this space, you want to fill the vacancy, you have to give these people money. Like they want allowance money, tenant allowance money. And if I come in and I go, okay, I'm going to buy this deal for $10 million and I need $2.5 million tenant allowances. I'm going to need another $500,000 in leasing commissions at 6% on a 10-year lease. Let me just bake all that in. That's my CapEx dollars, so to speak. And I'm going to either borrow the funds, raise the funds. I'm going to be prepared for it. Well, these guys are like, well, I've owned it for 15, 20 years. I don't owe anything. It cash flows. I'm not giving you any money and I'll just let the space sit vacant. But they're also, it's like, hey, I'm making $100,000 a year. Well, they're not putting it in a pro forma to realize that you could be making $400,000 a year if you filled the space and got everybody up to. I give you an example. We're buying a center. The average rate there is market rate's $25 a foot. There is a little donut shop paying $6 a foot. Okay. Right. Without paying triple net. So they're not even covering. So the triple nets at this center are $10.
So that's a net loss.
It's a $4 net loss. And these people are a year behind. That we're under contract in the center. And we're like, but I guess if you have 35% vacancy, why kick them out? It's just another vacancy. But the center, there's caution tape around a hole in the grass, and it's been there for like a year. They just didn't fill the hole. So this is what we deal with, but it's a completely different. So normally the value add play is not, it's not normally. The value add play is not, I cannot go into this space and paint the walls and put in a security system, get an extra $200 a month. So that being said, if I find a center that is fully occupied and everyone's at market rate and they're all in 5, 10-year fixed leases, that's great cash flow play. if you just want to park it and make 6% or whatever, but it doesn't work for me. So the value add on these is 100% operational. We look for that.
Okay. All right. So what's the average? You gave a square footage size. Does that typically equate to like number of tenants in one of these places? Like, is that like, hey, these strip centers are normally 5 to 7 tenant spots, or does that vary wildly?
It varies wildly. Like we have one that is 35,000 square feet, but it was an old Hastings development with a shadow space next to it. And the Hastings is now a Planet Fitness, and they're 20,000 square feet. And then there's 5 spaces next to it, whereas we're under contract right now on 37. So call it similar square footage, and there's 15 tenants, the biggest one being 5,000 and 3,000 after that. So It does, I'd say it varies. We
so y'all sometimes acquiring that large anchor unit as well? Okay.
Yep. Yeah. I mean, if it's part of it, absolutely. We do not go, there are certain people that will specifically in this space go after grocery anchored or something like that. It is nice to have it around there, like that center where the fitness center is, there's an Aldi there. And so they're technically grocery anchored, right? It's Aldi's a grocery store, but it's in the same market as the Academy Center we have. And that center does far better. So, because that's one of the big trends in that space is grocery anchored. And I get the benefit of it, but we don't specifically go after that.
Aldi's kind of a unique one to view as that anchor, because it's kind of like small. The stuff that's there is different than your normal grocery store. Yeah. So the foot traffic is probably less even like per square foot of shopping space, I would assume.
Good point. Yeah, that's a good point. Yeah, if you're next to an HEB, it's just, the thing is, if it's a 20, the problem with that is, and the way we buy them is, I can't really find that anchor because of the vintage that we want. That HEB is now an Ollie's, and HEB has moved on down the road,
We have multiple HEBs planned in our neck of the woods, and it's like the HEB we have might not be the HEB we keep after they build these new ones, 100%. It's like,
when the HEB is 20 years old, the center is not going to be grocery anchored for much longer. So
yeah. Okay, so so let's say someone is like, oh, I like the idea of that space. So obviously they get in contact with you, but then they start getting on other guys' lists. What are and obviously, like, you as the GP are doing most of this or all of this, but these LPs need enough information to ask the right questions. So when you're looking at these spaces, maybe it's mostly occupied, right? But the rent is well below market. Is there any sort of factor that you're using when it comes to the type of renter? Like, do you view a signed lease from a smoke shop the same as a donut store or the same as the liquor store? Like, how does the actual renter in the place you're buying impact how you view things?
Very good question. And not to knock any specific types of businesses by what some mean. So I won't list specific ones. I'll
just say I see a lot of turnover in the smoke shop space. I'll throw that one out.
So we have multiple smoke shops. So I'd say we have one of our centers that is, it's not like it's not this big high traffic, nor is it a very expensive center. It's lower on, it's $12 a foot, not $25 a foot. Yep. And we have a smoke shop person in there, and I think they have 2 locations and, a little bit more flexible on the application. We have a very high traffic location that has a smoke shop in there that would I have let the 2 tenant person go in there? Probably not. But they have 250 locations. We were like location 220.
Yeah.
I mean, it doesn't matter at that point, right? We're safe. Yeah. So, but the biggest part of that when you're taking on existing ones is knowing the tenants that are in there. And that's where a ton of the due diligence goes in, because it's a lot of times it's not what I want. It's what was agreed upon. You get an Edward Jones and multiple just places like that. They dictate what goes in there, but we also try to say, okay, what is our surroundings? What other businesses are in there, and how do they flow together? So it is a strategic game on that, because just because someone feels like my approach has always been, these tenants are 100% our business partners. I mean, we are in business with them, because these smaller businesses, the rent and the triple net is a huge portion of their expense, the largest, so we're business partners. But it definitely impacts it, and it definitely varies by center. The ones that we're buying now, we are definitely more selective on that. And we really look at how sustainable, the tenant can be. Like, for instance, nail salons are are great plays because they cost so much for them. They put so much in to get a nice nail salon up and running. And A, they're probably not going to go anywhere. And B, even if they do, a pre-developed, plumbed in nail salon, hot commodity. So I'm probably going to have to give a reasonable rate to these people because they're going to go put hundreds of thousands in. If they don't make it or renew at year 5, now I can get full market rate for that pre-plumbed in nail salon without giving the TI dollars.
So a little bit kind of like an investment, either long-term investment with that tenant themselves sticking around. And if they don't, bring someone else in and you're getting a higher rate of return on that.
Yep.
Okay. Well, when it comes to these businesses, you as a prospective buyer, do you get any insight into their finances, like the tenants, or is it just the property owner, landlord, financials you get to see?
If like for the tenants, if they're already in place?
Yeah. So if they're already in place and you're a buyer, like, are you able to, and the reason I ask is like, well, if you've got 3 entities that are struggling and they're behind, but they're still somehow managing to make their rent payment, or the owner of that business is paying out of pocket, right? That's not a great situation to be in because that business may go under fairly soon, even if they're current on rent. Like, are you able to get that kind of insight into the tenants?
It all depends on what the lease states. So one, if it was required in the original lease, they should have it on file, which most of these are going to have that. And we get to see that. And then is there a requirement that, they have to provide it every so often? And what is the frequency? That they have to turn it in. So if it's there, then yes. A lot of it goes off of the historicals though, like if someone's been there 3 years and they're paying like clockwork, I'm not going to be super concerned on how they're doing it, but we've had some where we take over a center and they were a perfect paying tenant. That's what they showed on the books. And we had one, I'll give you one. They had just put a fortune into this space, right before we took over. They had I think they had a 10-year lease in place. Everything financially was great. And husband and wife own this place. This husband and wife decided they didn't like each other 90 days after we purchased the center. So neither one of them's putting in the effort. It just starts falling apart. I mean, but that's no difference than a multifamily or anything else. There's the unpredictables. But now for a new lease, we 100% dive in. You get personal guarantees, and but when you're taking over, it is tricky because, like, I can't turn, an apartment complex within 12 months. It's safe to say I can turn all the bad tenants, all the bad leases, have them all updated. I'm in a much longer play. And, if they did these tricky half gross, half triple net lease, or you don't have to recover, like sometimes they write in, well, you're triple nets, but it's at a max of X dollars. Some of these big companies will write in that, yeah, I get it's triple net, but I'm not going to pay more than this. And if they agreed to it, you have to catch all that language and then just really bake it into the pro forma. I know taxes may go up so much every year, but this guy right here will never have to pay that increase past this. So it's
okay. So that's a good question. You're talking about the different types of terms that can be in the leases. Do you have a specific lease model that you implement when you're bringing on new tenants? Like, do you do triple nets, or does it vary from location to location? What kind of questions should an investor be asking the general partner when it comes to this?
So, I mean, if you're looking at the underwriting model and, that extra income, right? And it's not like we're billing back just rubs or parking spaces. It's everything. So our model is full triple net. So we're going to bill back everything except for normally things that are like a full roof replacement or, structural, like foundation fails. Those are normally the 2 big things that aren't on the tenant. But there are these big, like we have leases with A&M in one of our spaces, and it is what it is. Like they will not follow. They don't care what your rules are. This is how we write. This has to be the lease language in there because we're protected. So you have to go with those on a, kind of a case by case basis. But, that's when you're looking, it's really important to look at the, one flaw I've seen a lot when I've looked at, pitch decks or OMs is, it's triple net. So they have, expenses are 40,000, recovery income's 40,000, and it just stays that way. The model matches it. No, because you should still I get the centers 100%. We're still going to bake in an 8 to 14% vacancy rate at all times. Mm-hmm. And you have to multiply that vacancy rate off the expenses as well. like, our early models, it wasn't matching that. We'd be conservative on the occupancy, but then it wasn't conservatively hitting those expenses. And then we caught that. And so now we fixed that. So yeah, I mean, but that is a big play. Like, if you find it where, we bought centers to where there's a lot of what, we call a gross lease. So, if they're paying $5,000 a month, that's all they pay. They don't pay any expenses, but that's a good opportunity to convert them, because you can go to someone and say, look, I'm not upping your rent at all. I just need you to start paying your triple nets. And that's normally an easier conversation than saying, hey, I know you pay $5,000 a month and $3,000 in triple nets, and I need to up your rent because I need to increase income. So it's the latter is a little bit harder conversation. So that's a pretty big play in that space, is buying centers that are 100% like market comps or triple net. But it's an old owner that's gross leasing everyone. That's a big play.
Okay. And do y'all do, and I don't know if I know the term for this, but like the lease based on like their revenue or their sales, do y'all do any of that? Or is it, y'all might acquire something that's gross, as in just a lease payment, and then you try to move them to triple net?
So we have not, there's been centers where that's already in place. Yes. But we have not, and I'm not saying that we wouldn't. That is harder to predict, then
you're a real business partner. Like,
yeah, you're a real business partner. We've underwritten quite a few that had it. But we do not have a whole lot. I can probably think of maybe one or two in our whole portfolio. And I think that's just where the cards have fallen. But I also think that that's because, again, getting to that vintage of the center, I think when you're seeing those type of businesses going in, they're going into these super high traffic, $50, $80 square foot centers. And that's how they're like, look, I can't just bake in $80 a foot, but I'll give you 20% or 5% of sales or something.
Yeah. Okay. All right. So what on these types of deals, what's the most common reasons that, these types of investments fail?
I would 100% say it's the poor management and poor marketing of the spaces, because what'll happen is you get it to that 100%, you get it to where it's good. And like think of a multifamily, it's never good. 95% is 95% this month, and we reset with move outs on the first. But you could get into like a 36-month like utopia run where it's literally mailbox money. Like property manager sending us a report. I mean, like I have one. I spend 5 minutes a month, but if you got to be careful if you don't. And then the leasing company kind of forgot about it too, right? So especially because in this space, property management and leasing are two different people. So it's not the same person. So it could be the same company, but the leasing agent is like a real estate agent. He's getting paid 6% on the value of the lease. He may work for the same company, which a lot of times they don't, than the property management company. So he's worried about the other thing. Property management company is looking at expenses. And don't get me wrong, I'm not saying they miss when the lease is coming up, but you get comfortable, I guess. You get complacent, and then now it's okay. Well, we got to get back to work. We got to find new tenants and start preparing TI dollars. And then that piece is A, you were complacent. B, did you budget for it? So like right now we have a 10-year hold center that we're going to, I don't know if we're going to model a 5 or a 10, right? But we're looking at the 10. Well, did you bake in the TI dollars and the leasing commissions at year 6 for those tenants that are moving out? Assuming that they don't, I get they have a renewal option, but they didn't. You've been distributing cash flow for 5 years. Everybody's hunky dory. Now I need $150,000 in TI dollars and leasing commissions for suite 100. Yeah. Where are we getting it from? Oh, by the way, can I get the last 5 distributions back, please? Or you refinance it. So, but then it's a double-edged sword. So then if I'm an LP, I'm going to go, so you're going to bake in $500,000 that you may need at year 6? Like, that's insane. I mean, am I getting paid interest on that because it's just sitting in an account over there? And then how do you make it perform and underwrite when you're having to raise an extra $1 million that you may never use? So that's a fine line. And what we tend to do is like, maybe that's when the exit comes, right? That's also a good, that's all happening in year 6. We'll sell it in year 5 so the next guy has some upside. Yeah. So this is a little bit more strategic on the vacancies and the move outs there. Okay.
All right. And that's I think it's a good segue into, while I know it can vary wildly from deal to deal, what's a typical or ideal, like deal frame, like the business model for individual deals? Is that like 3 to 5 year holds? Is it 5 to 7? Do y'all like to hold them forever?
I normally I don't pencil anything on a 3. It's a 5 minimal. I like to pencil 7 and 10s. And what I'll do is I'll look at the 5 and the 10. And if it's like let's just use like the multiple, for example, if it's a 2.5 on a 5 and a 3.8 on a 10, well, 3.8 is higher, but that's the math is worse, right? The better return is at the 2.5. I do put in there, like I give myself the option to buy these out, like at market value. So at year 5, if the investors are ready to exit, and I look, it just depends. Like, we did, multifamily, you'll sometimes see longer holds, because if I'm going to be forced to refi at, say, year 3 or 4 and it's not time to exit, well, I don't want to sell it a year later if I just did a big refi on it. The centers are normally are different, because you're never assuming debt virtually, and it's always going to be 5-year. So it's kind of always time at year 4, to start marketing it, because the loan's going to expire. So, but like, we bought one earlier this year, and it's just us and one person. Like, we just split the check, and neither one of us have any desire to sell it. So it'll probably be a 10, but if there's a bunch of people in it, normally 5s.
Okay. That's good. Well, let's transition a little bit on these types of deals. So I just asked you a minute ago, what's the most likely reason it fails? That's a deal that's been like maybe put together and operating. From a limited partner's perspective, what should be the biggest red flag in this asset class when they're talking to general partners?
I mean, one would be what I said a while ago. One would be they're not preparing for the long haul. Like, they're just looking at that, I'm stabilizing year 1 and I filled it up with tenants. But then what happened in year 3 and 5, when I would say, okay, it's that, but intensified. The bigger tenant, the biggest red flag, or the biggest fear I see when I've looked at these, because I have money in these, is there is a Planet Fitness anchor that leaves at year 3. And I say, what is the plan? Or someone asks me, what is the plan? Oh, we'll release it. It's 20,000 square feet. Like, you don't just release it. So I'd say the big tenant in 2 ways, if not being prepared for, are they the big tenant space wise? Or are they the big tenant money wise? Another big overlooked one is, okay, this is a $25 center, and you have this dental office paying $50 a square foot. And then he has a 5 years left on his lease. In year 6, I have the same 50 in my underwriting when he leaves. But the one-off, he's only paying 50 because the landlord spent $2 million or $1 million on his build out, and they rolled it into the lease because they were like a national group or whatever it was.
Yeah.
They are not going to renew. They're going to go back to market, which is going to be 26 or 30. And that is so easily to get missed. And if they're 4,000 square feet at an extra $25 a foot, I mean, what does that do to your NOI at a 6 cap? That's going to just murder the exit. And it's easy to miss. It's very easy.
All right. Well, and now I'm going back a little bit. Normally my red flags are basically the last couple of questions, but you just mentioned the NOI and a cap rate. And you've talked about you really like to focus on cash flow, which you don't need those if you can pencil out cash flow, right? But how do you increase the value in these centers, right? Obviously, for anyone who's semi-familiar, the value is going to be based on your net operating income applied to your cap rate. But what are the levers that you typically use to impact those the most? And then on the NOI, is that purely market, or can that be adjusted based on either lease terms, length of the leases, the renter in the place? Like, what impacts the cap rate?
So levers you pull are the lease renewals or the vacant space, right? So when we go to sell, we're not going to sell with vacancy. We buy with vacancy. We don't like to sell with vacancy. But so if someone's looking at one of our centers on an exit, it would be, okay, what leases are expiring? What renewals are coming up? Let's say, but where it varies a little bit is that the NOI, I'm selling it today, but as a buyer, I can look at it and I kind of know what the NOI is it's not just 3% annual increases like apartments. I know what this NOI is going to be in the next few years because it's fixed, right? That's guaranteed increases. So you have to get very strategic on that. But I'd say the biggest lever is are those renewals and what you can do with them, especially someone that's massively under rented. Like if you have someone that had like a 10, 15 year lease at $12 a foot and market's now 25 and they don't have a renewal option, but they've been there forever and they're doing very well, to your point, like let's say it is national and you have their financials, well, they're not going to go anywhere. So that's a huge play on it. But based on that, we value it the same way. We do, like if there's a big increase coming on, a lot of times when we pencil them out, I know there's this huge increase in year 3 that they've just, it was baked into the deal and they're going to execute it. Well, I'll look at that and strategically do the refi right after that kicks in.
Okay.
So that's when we'll do our kind of like mid hold refi.
Okay. And what changes when you have a lease that expires in 2 years versus a lease that is brand new and is maybe a 10-year lease? How does that impact the value? Or does it just, you have to take a look at, well, how likely is that I'm going to re-rent it at the same rate or market rate? Like length of terms, what does that do for you?
You kind of want a mixture of both. So the 10 years nice because it's stable. But the guy that's fixed for 10 years, unless someone's just giving you a phenomenal purchase price on it, there's no value you're going to add. You're not getting to a 2.5x multiple in 5 years on someone's money if they're all 10-year fixed rates, unless you just bought it super cheap, right? But those are nice to have, because if I have 20 tenants, it would be nice to have 14 or 15 of them that have 5 or 10 years on it, so I don't have to worry about them right now. The other, say 5, the 25, 30% that are expiring or on month to month, those are the value add play. So that's where you just, and in that feasibility phase, like what is the market rate? What can I increase it to? But then it's just strategic play of, okay, market's 25, they're paying 15, but then what does it cost me to release it with TI dollars and leasing commissions? How much of a discount can I give them? Because just like an apartment, there's something to be said about not having that, call it a turnover cost, right? So just playing with that, and that's where the risk is involved, because now you're, it's not a guaranteed. The 10-year people are guaranteed. So, if you can have like a 70-30 mix between those long-term and non-long, it's a pretty good setup.
Okay. All right. And then one of my last questions is the cap rate impacted by tenant type in any way?
Yes.
All right.
Yes.
So give me the tiers then.
Yeah. So, market and tenant type.
Correct.
So we have a space. There's only 3 tenants in it, but they're all 3 national tenants, right? I think that the pro forma is at like 6.25 cap, but market will get better by the time we take that thing to market in a couple years. It'll probably go down into the 5s, because they'll still have 7 to 8 years left. They're national tenants, and I can now market if it's nothing but national. It's okay. It's so think of it as there is the just single tenant triple net Walgreens, right? Then there is right below that is, okay, it's a multi-tenant center, but they're all nationals. So yeah, I got to do a little bit more work. I got to reconcile them. I got to make sure that they play nice together, whatever that may be. So that's kind of the next most aggressive cap rate, because you'll still sell it to some big groups because it's pretty easy to manage.
Because their lease agreements are backed by parent company.
Absolutely.
Yeah.
Or they are the, Edward Jones is one, like local operators. And a lot of people don't know this, but like the local operator that you're dropping your check off to, he's not paying the rent. Edward Jones pays it on every single space. So if you can get like just filled with these national groups in there, that's going to sell to a whole different tenant than even if I have 10 spaces, and let's say 7 or 8 are national and 2 of them, then you got the nail salon and the donut shop. You're still the guy out of California or wherever that just needs to park $10 million is probably going to steer away from that, because it's going to be more work involved with it. So yeah, I mean, you're definitely going to get a lower, cap rate if it's purely national tenant base with longer lease terms, because a national tenant with 6 months left means nothing.
And then I assume, as you said, that as you get down to closer to like true single location mom and pop, that's going to be the least attractive cap rate modifier.
And then it's who they attract in there too. Like, there's a school in Houston that, they're opening locations like crazy, and almost everyone knows, man, if they open a location, everybody's going to follow them. So when you see them in a center with a bunch of vacancy, someone will follow them. So that's the other thing too. Like, Edward Jones probably isn't going to jump up and down because like that's where the resale is too. Like if it's nothing but, smoke shops and donut shops, probably not going to get national tenants come to it. So, I mean, you kind of write the future of these centers as you start just kind of taking the fast money, and then it's going to turn away a lot of your bigger buyers. I mean, in that sense, it is just like because you have to have some upside in the deal when you go to sell. It either has to be structured with national tenants where it's just parking money, or it's going to be grouped like ours and you need upside.
Okay. All right. So now I really am transitioning towards the end. What I like to ask is some of the lessons that you've learned. So maybe first, because you mentioned you did some passive investing. You haven't always entirely been doing your own deals. So when you were passive investing, what was the biggest lesson you learned as a passive investor in that time, or even now as a passive investor?
The biggest one. I mean, I'm in a few deals with that I thought was just a phenomenal operator, and I think I'm a great judge of character. And I guess I got a little comfortable with him because it was passive. Because I would more than I'd ever be comfortable in something that we manage, because I'm OCD with things. But because it was passive and there was a few decent deals going, I got a little comfortable. And then he completely went. I mean, halfway fraudulent. I don't know. Jury's still out on that, but almost literally jury's going to be out on that. But so I learned that piece of it. And then I also learned, if this is someone that's going to be passive and stay passive, I don't know if this lesson would work for them, but if you've had any active experience, you just really need to make sure you're prepared for it, because I wasn't a very good passive investor. Like, I still wanted to go see everything, touch it, drive by it, and I don't necessarily think that's a bad thing. I have people from that, I have someone flying in from Utah that's coming to do a property tour. Like, I don't think it's a bad thing to go see where you park your money. There's a difference between touring it, once a year and calling 55 times, or asking,
wanting biweekly updates on.
Yeah. Like, did Unit 203 renew? But I would say that's from a passive standpoint. It was just knowing that, determining that what your path is, and then just really getting comfortable. But I'd say the biggest lesson is I was really comfortable with this GP, and it didn't work out.
Okay.
And I met them, talked to him, had endless evenings of dinner, and I still think that he's a good guy that just got caught up in, so I think it doesn't matter how great the person is, it can still fall apart. It just kind of shows you it's always the jockey. So,
okay. All right. And then the final red flag question is unrelated to your asset class.
Okay.
What's the biggest red flag that limited partners should be looking for when they're reviewing any type of passive investment?
Can I have two?
You can have two. That's great.
Overall experience is massive for me as an LP. I think there are people that are great at raising capital. I think there's people that are great operators and have experience running properties. You have to have the latter for me. And then the second one is the co-invest. That's huge for me. I won't do a deal I do the deal so I can co-invest. So if someone's not putting money in it, I'm out. So those would be my two biggest ones. What is your experience and how much money are you putting in it?
Okay. And how much of their actual money they're putting in it, or how much of the money they're charging you that they're putting back into it?
Yeah, both. Which we could have a whole nother hour conversation I on that as well. But yeah, absolutely. I mean, regardless, even if it's coming from that, it's, they at least got some skin in the game. But yeah,
at least they're not just taking a big check and running. You're right. That is better than nothing. But
a lot of times those two correlate. It's someone I'm great at raising capital. I'm raising capital for this deal. I have no experience in doing anything. I put no money in the deal. I have no experience, but I'm going to put your money in this deal, and then I'm not tied to it in any way, form, or fashion.
Yeah, that sounds great for him.
They're both Brian. Don't mix them together. So,
all right, Brian, tell us what y'all are doing currently, or if you're doing anything currently, and if someone is interested in talking with you further, what's the best way to get a hold of you?
So currently, what you'll normally see from us is we will have one of each class we just talked about going that we normally will onboard one at a time. And we actually, we are under contract on a center in Sugar Land we're bringing to market in a few weeks. And we are contracting, 280 unit, multifamily we're bringing to market in a few weeks. So those will be on our portal. Furgmarcapital.com is our website. You can register and log in there, or I'm on LinkedIn and Facebook. And feel free to reach out. I talk to everyone directly myself. So,
okay, awesome. Well, we'll have all that information in the show notes. And Brian, really enjoyed it. Thanks for being on.
yeah, same. Thanks, man. Thanks for having me.
Okay, well, I hope you enjoyed that conversation with Brian as much as I did. And I think my two takeaways, one was that I really enjoyed learning about the types of deals that he's doing, the strip centers, the neighborhood retail centers, right? That's something I knew very little about. So that was great to just deepen my knowledge on that. And then two, the value of consistent cash flow, right? That's not dependent on a floating rate. So if you have reliable cash flow, you're going to be able to weather storms a lot better than anyone who doesn't. And so really not investing for like the maybe upside, but investing on solid terms that don't require major wins at the end. Now, if you are new to investing, if you are new to the channel and you need more information like this, hit that subscribe button below. Keep coming back for more information. And if you are looking at deals and you are just not sure how to process them well, how to do your due diligence, how to read through these documents, these PPMs, these, deal memos and all this stuff, go to the description, get my free guide of how to use ChatGPT for due diligence. Take a grab. Grab that. And then if you have more questions and you want some feedback, you want some help, feel free to give me a call. Love to connect, love to chat. And until next time.